The way to get rich is to keep $10 million in your checking account in case a good deal comes along. Charlie Munger said this in 2015, and at that time, he had an estimated net worth of around $1.3 billion. Now, obviously, it's going to be tough for most of us to follow that advice because that is a lot of money, but in this video, we're answering the question, how much cash should you have in your portfolio?
We do like having a lot of money to be able to operate very fast and very big, and we don't, and maybe we won't. We know we won't get those opportunities frequently. I don't think, certainly, in the next 20 or 30 years, there'll be 2 or 3 times when it'll be raining gold and all you have to do is go outside.
So when he says raining gold, he's referring to those moments when the stock market is getting crushed and stocks are selling at massive discounts. However, there isn't a clear-cut answer here because check this out. This is another clip of Warren Buffett saying that he doesn't like holding cash.
We obviously are looking every day for ways to deploy cash, and we would never have cash around just to have cash. I mean, we would never think that we should have a cash position of X percent. And frankly, I think these asset allocation things that tacticians in Wall Street put out, about 60% stocks and 30%, we think that's total nonsense. So we want to have all our money working in decent businesses, but sometimes we can't find them, or sometimes cash comes in unexpectedly, or sometimes we sell something, and we have more cash around than we would like. And more cash around than we would like means that we have 10 or 15 cents around because we want money employed.
So on one hand, it's good to keep some cash around, but on the other hand, it's preferable to be fully invested. Warren Buffett has written in various shareholder letters over the years that their hurdle rate that must be met for them to invest is 15%, meaning they're not going to invest money unless they're going to be able to get at least a 15% annual return on the investment. So that's why cash starts to build up for them. They would love to invest it, but sometimes there just isn't any opportunities that will give them the returns that they want. And so they wait. And here's a good way to look at it. If you invest $1,000 today and it earns 10% annually, after 30 years, you'll have $17,449. If instead you waited to find a 15% investment and waited for a full 9.5 years before you found one, and then you invested the $1,000, well, 20.5 years later, you'd have $17,551. What this means is that Buffett and Munger probably believe they're going to be able to find an opportunity that they like at least once every 9.5 years. And so waiting and letting cash build up is acceptable to them. And on top of that, there is always the slight chance that stocks will become extremely cheap and they'll be able to get much more than 15% annual returns. By the way, if we look forward another 10 years into the future in both scenarios, at the end of it, you'll have $45,259 in the first scenario where you're earning 10% annually and $71,000 in the second scenario where you're earning 15% annually. And you know these guys are long-term thinkers. So the better question to ask really shouldn't be how much cash should I hold in my portfolio, but rather it should be what is the minimum annual return I want from an investment before I'll invest. At one point when Berkshire was much smaller, their hurdle rate was 20% annual returns before they'd be willing to invest. But eventually they had no choice but to lower their hurdle rate to 15% because as they grew in size, the universe of stocks that they could invest in became smaller and smaller. This, however, by the way, is not an issue that we as smaller investors have. And this is something that I explain in more detail in the video that I'm going to suggest at the end screen of this video. Now, my opinion is that if you're going to be in the stock picking game, your hurdle rate should be at least 15%. But I also think that finding 15% annual returns investments isn't going to be that difficult for anyone working with smaller sums of money like probably you and I. You will definitely not need to wait 9.5 years to find one. So you may even want to bump that up to a 20% hurdle rate. Now here's my opinion. If you're a beginner, I think you should be doing a budget and figuring out how much of your income you can be putting aside for investing. Have that money set up to be automatically deposited into your brokerage account so it's ready to be deployed. And from there, I think you should be constantly on the lookout for stock opportunities. And if you find one that meets your hurdle rate and your other criteria, then go ahead and buy it. And if you can't find anything that meets your hurdle rate, then just keep waiting and keep researching companies and build up a watch list of companies that you'd like to buy one day if the opportunity presents itself. Something Charlie Munger says is that you have to be very patient. You have to wait until something comes along, which at the price you're paying is easy. He's often talked about how successful stock investing requires a weird combination of having the ability to both be extremely patient combined with the ability to be extremely aggressive when the opportunities present themselves. And that's part of what they mean when they say temperament is largely what determines how successful you are at stock investing. Now, another opinion of mine, which is going to be a little more controversial, is that it might be okay to borrow a little bit of money to invest once you know what you're doing. But perhaps give yourself a 25% annual returns hurdle rate that must be met before you'll tap into borrowed money to invest. You're never going to want to use a margin account though, because you never want to be forced to sell your stocks if the stock market decides to tank. But what you can do, especially if the economy is hot and banks are lending money very freely, go to your bank and get yourself a personal line of credit for as much money as they'll give you. And if you own a home, put a home equity line of credit on your property to the maximum that you can get. Now, this money will serve a double purpose as both your emergency fund and your take advantage of disgustingly cheap stocks fund. Again, don't do this if you don't know what you're doing yet. And also, before you invest that borrowed money, make your investments meet a higher requirement hurdle rate. If you have any opinions on this subject, let me know your thoughts in the comments. I'm actually very curious to hear from you on this one, so please let me know. Now, I mentioned earlier that it's much easier for smaller stock investors than it is for the big money stock investors to get high returns. And so if you want to know why that is and how you can benefit from this advantage that we have, you should check out this video right here next. So click here or tap here right now to watch that one next. And also a quick disclaimer, I'm not a financial advisor and I'm not your financial advisor. I'm just someone that loves money and loves investing. And so I'll see you in the next one. Thanks.